welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us our Janakiraman, Deputy CIO and Senior Portfolio Manager, Equities for Franklin Templeton India AMC.
Thank you, Ruchira. Glad to have this opportunity.
You started working in the financial markets for the past, say, around 1997 kind of thing, and you worked with UTI Securities and then another firm. So just wanted to understand, was it a college placement, or did you join the firm? What kind of led to the start of the job in the financial markets?
Chirag, so I've had an inclination towards investing for a fairly long time, right from the slightly younger days itself. So I used to be on and off an investor during my college days. The interest in this was kindled by a nice neighbor that I had during my college days, a college professor. So that interest kept growing from that point. And when I graduated from business school in about 95, I think there was a reasonable clarity that I would pursue an opportunity in the investment space. So that's how it started. And so I do not have too much doubt about where I wanted to build a career. That was one. Of course, second is that fortune also plays a big role. The fact that I was present in a growth market when I started my career, and that to a growth market which started to open up and expand. So that gave quite a bit of professional opportunity for the next 20 years or so. So while there was an interest from my side, I think the market growth also gave enough opportunity to satiate that interest. I keep thinking that, for example, if I had the same interest and been in Sri Lanka or Argentina, then the career would not have developed at all.
Sir, another thing I want to understand, Franklin Templeton equity team sits in Chennai, and most of the financial hub is in Mumbai, and you have worked in Mumbai. So what are the advantages of, sitting in Chennai compared to Mumbai, which is still a financial hub?
On a lighter note, the biggest advantage is much less commuting time. So you have much more personal time available to yourself. But I think professionally, the advantage also depends on what is your investment style. I don't think the advantages remain the same for all kinds of investors. If you look at Franklin, generally the emphasis has been on long-term investments. The firm also tries to encourage that kind of a culture when you evaluate investment opportunities. So from such a perspective, being a bit farther away from Bombay is not a handicap at all. It's probably not a bad advantage to have. It definitely helps having and actually expanding on a longer term oriented investment philosophy. So that helps. The second, it helps to some extent to reduce the role that noise has in your decision making process. In general, we don't respond to short term triggers too frequently, of course, on and off years, but in general, we are a bit willing to look beyond the short term noise. So the distance from Bombay helps this. And of course, nowadays, there is no disadvantage in terms of flow of information. Compared to 20 years back, now information flows reasonably quickly. So whether you are in Chennai or even whether you are in Coimbatore, that distance doesn't matter.
All right. Janaki, how would you define yourself as an investor? As in what kind of stock or situation excites you?
Ruchira, in general, I would classify myself as a careful investor. My approach has been to make returns by investing in good quality businesses. there are a few operational financial parameters that I seek out when I evaluate businesses. So the choice is to invest in good quality, steady compounders and generate the returns. That's the approach. Now, given that this is the approach, the interesting opportunities come only during bear markets. So those are the times where such good quality businesses tend to trade below their intrinsic value. If you look at our own history in the last 10 years or so, 2012-13 or 2018-19, those were the times where I think a careful investor had a good amount of interesting opportunity in the market. So those are the times that I found quite satisfying also.
All right. And what kind of stock do you think is a compelling buy for you?
Again, going back to that previous point, so good quality businesses which have a combination of good return on capital, free cash flow, and growth, very demanding requirements as far as a business goes. So such businesses are my mainstay. If you look at my investment philosophy, or even if you look at the portfolios that I run, so such businesses are the key part of the portfolio. Now, what happens is during some points in their history, such businesses go through some challenging phases. It could be because of internal issues, competition, or demand cycles. At some points, these good quality businesses go well below their intrinsic value. So these are the points where I would like to not miss out on such opportunities. One is, of course, the market itself going through some slightly dull or weak phase. The second is when good quality businesses go through those idiosyncratic weak phases, then again, those are opportunities that I would prefer not to miss out on. And that is where I think you can bring your understanding and experience and gain an advantage.
Right.
Mr. Janakiraman, so you spoke about the stocks which you buy and which are the stocks which is compelling buy for you. But what triggers the sell decision? When do you sell? And which stocks don't enter your portfolio?
So there's been some maturity that has developed within the firm, definitely in my own thought process also, in terms of when to sell. Clearly over the last 5 or 6 years, as the interest rates globally started to go down, of course, now they've started to go up again, but before 22 or so, I think we had a phase where interest rates, especially the long-term interest rates, were steadily coming down and the market valuation kept on going up. I also operate a lot in mid and small caps. So good quality businesses in mid and small caps saw meaningful increase in the valuations. Internally, so our tolerance level for the valuation for such businesses, tolerance level also went up, driven by the fact that the interest cost came down, because interest cost or the cost of capital is a meaningful input into calculating what is an acceptable valuation metric. So even after that, I think valuation went beyond our comfort zone in many cases. So how we tackle that situation is try to use a standard deviation kind of approach. If it's a very good quality business which has a good earnings visibility for the next about 2 or 3 years, then allow the position to continue in the portfolio up to about a 1 sigma standard deviation in terms of valuation. I think once it goes even beyond that, that is where I think the odds begin to start going against the investor. So that is when we also start to reduce the exposure to such stocks. So somewhere above 1 standard deviation, that is where we start to reduce the exposure. In terms, I mean, if you want to exactly quantify that, or specify the approach to valuation, that will be the approach. what kind of businesses I would prefer to avoid? By and large, businesses which are plagued by balance sheet stress. So, which means that they will have poor free cash flow characteristic. They're operating in businesses which are highly capital intensive, whether on the working capital side or on the manufacturing side, both. So in the past, my experience with such businesses is that low valuation is definitely not a compensating factor. So despite low valuation, they tend to disappoint investors. So these are the areas where I would prefer to avoid.
So since you manage multiple funds at the fund house, equity funds at the fund house, how do you juggle between them?
Actually, the list looks a bit long for a external observer, but if you look at it from an internal perspective, it is not such a demanding list. So, few things. One, the underlying investment philosophy across these products remains the same. That reduces the complexity quite significantly. So, the underlying philosophy is that, like I said, invest in good quality compounders. So, whether you look at FlexiCap or Prima or smaller companies, blue chip. So, this will be the underlying philosophy. That's one. Second is that internally we also club certain products based on their target markets in terms of cap. So while mid and small caps sit in one particular group, the other category will include products like FlexiCap, tax, and some of the equity hybrid funds. So for this entire category of products, FlexiCap, tax, and hybrid, the underlying equity investment approach is very, very similar. If you look at their portfolio also, you will see a high level of similarity across these portfolios. So, which means that while the number of products may be 3 or 4, the underlying investment approach or investment model is just one. So that simplifies, that reduces the complexity meaningfully. So, which is why, while on paper, yes, my name is linked to 6 or 7 products. If you look at it clearly, there are only 2 distinct investment models that are used. So that reduces the complexity.
Okay, and you co-manage a few schemes at the fund house. So what do you say, how difficult or how easy is it to work with, co-managers? They come with their own investment thesis. So how do you come at a common ground?
That's an interesting question. It also goes back to the firm's approach. Generally, Franklin is open to identifying good quality talent and grooming them for future higher responsibilities. I joined the firm here as an analyst in 2007, and then subsequently I was given portfolio management responsibilities 3-4 years down the line. So like that now, I would also at this stage prefer to groom certain younger colleagues of mine. So for example, there is a gentleman called Akhil Kalluri who supports me on both mid and small cap products. He has been with us now with the firm for about 7 years. He's not new to the firm at all. He's been with us for 7 years, and for the last 2 years, he's helping me run the mid and small cap products as co-portfolio manager. So we both know each other quite well. B, we know them reasonably well, so that we know each other reasonably well, so that we are prepared to give adequate space for the other person to operate. From my perspective, I do realize that I have certain gaps in terms of my skill sets. For example, in the quantitative part of investing and the portfolio data analysis part, these are all areas where Akhil brings in much more value. So I think working as a duo, it's beneficial to both of us, and more importantly, I think it also benefits the unit holders, gives the firm also a reasonable degree of continuity, gives the product also a reasonable level of continuity over the next 5 years or so. And the key thing is when 2 people run a product, I think you have to ensure that there are, if there are any disagreements, that is fine, as long as the two are not disagreeable to each other. That's fine then.
Sir, another important thing in finance is, managing investors' money and managing the pressure. So how do you deal with so much pressure of managing investors' money, or sometimes does it concern you?
One is we have to take the fiduciary responsibility very seriously. The way, for example, I do it is that I treat the portfolio money as my own money. So, which means that I will invest the portfolio in good quality businesses, which gives you a reasonable degree of safety also. Which is one of the reasons why, if you look at many of our products, through the cycle, the risk-adjusted return of our products stand out to be much better. So one of the reasons is that the way in which we invest, which is in a slightly less risky manner, identifying good quality businesses. Parts of the market cycle, this approach may underperform, but I think through the cycle, this gives you the best shot in terms of generating good performance, and more importantly, with a reduced level of risk. So that is how, for example, individually, I try to discharge this fiduciary responsibility. Whether there is pressure, I think once you have reasonable clarity about what your investment philosophy is, which means that it gives you a good ability to withstand cycles, because you also know historically what has happened. So that historical knowledge helps you in going through the current cycles without putting oneself under too much anxiety or pressure. So that is the way then you handle the pressure. And of course, third is we have a work environment which is fairly collegial. See, this is a firm which has run an asset management business now probably for 80 years or so. I think globally the firm started in the 40s. So which means that as a firm, the organization has very good experience in dealing with cycles, investment cycles or the market cycles. So given that experience, they ensure that the working environment does not put additional pressure on the investment professionals during those down cycles. So that is of a big help, if you ask me.
Once you identify the good quality business or particular stock, how does this stock enter the portfolio? What are the other parameters apart from the good quality which leads to you buying that particular stock in the portfolio?
Primarily, it will be valuation. So when I look at the good quality universe, let's assume that 100 is that universe. Out of that 100, today you'll have only about, especially let's say you take the mid and small cap products. If 100 is universe, maybe about 50 or 60 are there in both the portfolios combined. The remaining 40, while they are investable in terms of the quality of the business, the current valuation does not give me comfort. So that is the main reason. The second is liquidity also plays a role. Some may be good quality businesses with extremely low levels of liquidity. In such cases also, the time required to build a position, I think that comes as a deterrent. So I think those are the factors which play a role in terms of keeping a good quality business away from the portfolio. Otherwise, like generally, the portfolio will invest in more or less all that businesses.
Janaki, you mentioned that Akhil Taluri, he's been assisting you in managing mid and small cap funds. You started managing these funds at the start of the global financial crisis. So how has been the journey, navigating through various cycles in the market? And if you can share the lessons that you've learned through these cycles, especially when it comes to mid and small cap stocks.
I think a dramatic amount of transformation has happened in mid and small caps. If you start with about the 2008, the global financial crisis. In the last 15 years, we have seen meaningful degree of evolution. If you look at mid caps, for example, at least the upper half of the mid cap, today the quality of the business, the consistency in terms of execution, the width and depth of the research coverage that is available about those companies, I think that is as good as most of the large cap companies.
Right.
So we have seen that kind of evolution happen in the mid cap companies. Again, in the last about 5 years or so, we have also seen a reasonable amount of mid cap companies grow and then get included in the large cap category as well. So that segment, I think, meaningful evolution. And so in terms of the consistency and predictability, it is more and more coming closer to large caps. Small caps has seen a different kind of experience. Still, the range of quality that's available in small caps is much wider compared to mid and large caps. You have extremely good quality companies, and you have quite below average quality companies also, which is one of the reasons why in small caps it offers a much larger scope for the portfolio manager to show a differentiated approach. Having said that, even within small caps, 2023 versus 2018, meaningful difference in terms of the approach of the small cap promoters also. I think now you see far more small cap companies where for promoters, market cap is a meaningful objective. It was not so directly visible earlier. And because of this objective of market cap, now the level of transparency, the level of communication amongst the small caps has also gone up. Still, the extent of research quality is not very good when compared to large caps and perhaps the larger mid caps. But I would say that companies are now much more willing to talk to investors, communicate with them. Definitely, the volatility levels in small caps have been much higher. I think, like I mentioned earlier, the two weak phases in the market, 2012-13 and 2018-19, those were really dull times. I think those were the times where the small cap product valuation went to as low as 12 or 13 times current year multiple. So volatility is still a bit more amplified. The cycle's volatility is a bit more amplified in the case of small caps. But I would say that average quality of the business has gone up. And supporting this all is the fact that you've had about a 6% macro growth now for the last 15, 20 years or so. And that is an extremely powerful tailwind, which tends to push up all the boards, whether it's a small or a large board. So for an investor, at least, it's a good time to be an equity investor in India. So you have that huge macro tailwind that is supporting all these businesses. Yeah.
And since we're talking about mid and small caps, do you think the current valuations are scary?
I would say that there are certain pockets within mid and small caps where the valuation definitely merits that adjective you used. Quite stiff valuations at present. But I would not use that same brush to paint the entire category. Still, you have reasonable pockets of acceptable valuation in both mid and small caps. So one can avoid that extremely valued segments and then still build a reasonably effective, viable portfolio. That is one. The second is the fact that I would prefer to look valuation in conjunction with the earnings growth. One of the reasons why for the last almost decade, we saw a relatively modest earnings growth, and where every year the eventual earnings growth for the year definitely turned out to be less than the beginning of the year estimate, was the fact that the cyclical parts of the economy was not working, which is both the real estate cycle as well as the industrial capex cycle. I think both have seen revival over the last 2 years, which means that, like I said, the macro tailwinds will be much better for the next 3 years or so. This means that earnings growth, especially for mid and small caps, will be better. So in the light of this better earnings growth, does it justify the slightly higher valuation? I would still say that probably the answer is yes.
Janki, I just want to bring back to, around 2020 period of time when the markets were volatile and the fund house also saw some crisis, which led to people withdraw money from the equity funds. And markets were also not, were volatile and were giving negative returns. How did you tackle that situation at that point, at that period of time?
Being away from Bombay helped. But you have to give due credit to the business leaders who were there during that time. For example, our CIO Anand, what he ensured was that the investment team was not exposed to the kind of adverse publicity and adverse reaction that we saw from the market or from some of the distributors. He soaked up a lot of pressure, so which ensured that the others in the team did not suffer that level of anxiety. That's one. He spared them that experience. That's one. Second, after a very long time, see, we pride ourselves in terms of the stability of the team. And after a long time, during that time, we also saw some churn in terms of our team also. We saw the departure of 2 portfolio managers and about 4 analysts. So in the next 1 year or so, we have rebuilt the team. The team has been quite stable since then. Even now, if you look at the research team, which is about 11 strong, so their average experience with Franklin is now probably about close to 5 or 6 years. That's the average, even including the people who joined us over the last 2 years. So to some extent, I think the behavior of the leaders ensured that the team did not have too much of a tough time during that 20 and 21 time period. Of course, we did have redemptions. During the time when many of the other products, many of the others in the industry saw large inflows, we did not see those inflows. Now we have started to see some inflows of late. So to sum it up, if you ask me, was it a very traumatic experience? Actually, not so much from our side. The business lost out a bit, but in terms of the experience of the team, it was not such a traumatic experience.
Janaki, another thing, just wanted to understand the Prima Fund. You manage the Prima Fund since long, and the performance has not been up to the mark in the last few years, kind of thing, compared to the category average or the other funds in the category. What is your plan to improve the performance of the Prima Fund going forward?
That's a fair question. So this is how the picture looks. Till December 19, which is, let's say, till the onset of the COVID phase, the product's performance on 1, 3, and 5 year basis was relatively satisfactory. It was both against the index, and it was in the middle of the pack in terms of the peer group. I think we had a bit of tough time for the subsequent 2 or 3 years. Some internal issues also. One thing is that I allowed some of the underperforming stocks, some of the positions to continue for much too longer than I should have actually done. So these kind of systematic errors we are trying to now reduce, where the errors of commission, they tend to persist in the portfolio for a long period of time than what they deserve. So this is one area where some internal efforts are going on to improve a bit. The second is that if you look at Prima's performance in the past also, while it comes across as reasonably satisfactory versus the index across the cycle, typically it tends to do well in a flat market or in a slightly weaker market. So it will lose out in a very strong market because of the slightly more cautious approach, and it gains in the other parts of the cycle. So that is how the overall performance comes out. Last 2 to 3 years has been terrific for mid caps. So which means that the market this cycle has not seen the other part so far, which is why perhaps it's a bit, while I take the point that 3 years is a long enough period, and we've also tried to change some of our internal approaches, but still I would say that perhaps it's a bit unfair to look at the performance just at the end of a slightly strong phase. Maybe once we complete a full cycle, then a truer picture may emerge.
Janaki, last thing is, what do you consider most significant accomplishments and contributions as a fund manager, and what motivates you to continue working in this field?
I think it's the fact that we have helped manage the risk and build the wealth for many of our unit holders. I think that I would say is a reasonably big accomplishment. At least that's how I see it. When I go and meet some of the investors in distributor meets, especially investors who have been with us for a fairly long time, I come across quite a few investors who have been investors in Prima for the last about 20 years and whose SIPs are still running. And if you listen to their success stories, it does give you a sense of satisfaction that what you have done has clearly benefited your customers. That is one. Second, what continues to motivate me further, it is the professional satisfaction of doing well in a highly competitive industry, which calls for a good degree of knowledge of history, interest or curiosity in different kinds of different aspects of business, an intellectual framework that is flexible enough to accommodate new kind of inputs, new kind of markets, and also flexible enough to change to some extent depending on the market conditions. So it's a very exciting challenge, and that is the one which keeps me motivated, because this is a profession which tests you perhaps on a daily basis. Obviously, you don't allow that kind of pressure to seep into your mental thought process, but otherwise, like that is it's the professional satisfaction that keeps me motivated.
All right, fair enough. Time now to wrap up this chat. Thank you, Janaki, for joining us and taking out time for this interaction. Thanks.
Thank you.
Thanks to have the opportunity. Thanks, Chirag and Ruchira. Bye.